Hey everyone, and welcome back to another underperformance this week by the Couch Investing portfolio. We're down 1.76%, whereas the S&P 500 is up 1.64%. And this is despite a positive result in the Tesla shareholder meeting. This was a buy the rumor, sell the news type of scenario. So before the shareholder meeting happened, the stock popped. Afterwards, the stock dropped. With regards to the number 2 position, Google, flat-ish for the week. PayPal got hit because of the Apple announcements at their worldwide developer conference. Basically, they announced a groundbreaking new feature. Instead of sending and tapping on your screen, send money to someone, you can now use two phones, put one next to the other, and the same exact thing happens. How amazing is that? Anyways, more pressure on PayPal, no surprise there. SoFi, despite the positive inflation numbers, got the pump, then got the dump, as per usual. Palantir performed quite well during that week. Adobe saved my week here, up 14.52% because of a very, very good earnings report. Guess what? AI is not destroying this company. No, AI is actually enabling this company to become much, much stronger. If only I've been talking about that for a while. Anyways, that's one thesis that is already working out faster than all the others. Yes, I'm patting myself here on the back despite being down 4.7% since the start of this portfolio back in late February. Snowflake, despite all the new announcements, despite Jensen Huang actually trying to pump up their stock, this thing did not move much. Maybe I'll do a separate video with regards to Snowflake. If you would like to watch that, let me know down in the comment section below. dLocal continues to drop. I've seen zero news with regards to the company. So it's either lots of short sellers or something that will come out soon enough but is not public yet. So I have nothing to report. Other than that, I'm seeing red each and every day. Lululemon performed well, flat-ish for the week. Same with Meta. Same with Intel, and of course, Celsius. The day after I made my video, we have what I predicted in the video. We have the information that came out and became public. A little bit more analysts are negative on the growth trajectory right now with some weakness in that market. Okay, let's wait and see what happens because the growth rates are still quite okay. The stock has run up quite a lot, still $60, fine. We'll see what happens in the next quarter. Rocket Lab, Appcelera, those are the long shots, moonshots. If that work out in the long run, fine. If not, it's a tiny, tiny position in the portfolio. So that's basically the big summary for the week. I do want to focus on the 10x question because that's basically in the title and in the thumbnail, right? Everybody wants a 10x. Everybody wants a 50x, a 100x, right? A 100 bagger. Everybody is looking for that in the investing community, especially retail investors. But what's the problem with always wanting to have a 10x or a 100x? What's the problem with that? The problem with that is that along the way, your holdings will be down 30, 40, 50, 60, 70, sometimes even 80%. Now, most retail investors, as we've seen in the past videos, most retail investors during bear market, they jump ship, right? Like Theon Greyjoy, jump ship, gone. That's not how you will get your 10 or 100x. Yes, sometimes you can get extremely lucky, right? You buy in March of 2020 and then a couple of months later, there is a pandemic, cool, everything is up 5, 10x or so. Yeah, but hopefully we don't get pandemics every couple of years, right? Anyways, the thing here with the 10x, and I'll show you a couple of numbers that I've compiled, let's say, fancy schmancy words. I'll show you that companies, very, very famous companies, right? Because we say, oh, but those are the obvious names. Yes, but back then maybe might not have been the obvious names. And despite them being obvious names, they kept on going up and up and up, and the returns are quite something. Again, going back, we want a 10x, we want a 100x, but will you have the stomach to hold on to your bags, let's say, when your position is down 20, 30, 50%, maybe even more? Will you have the stomach to dollar cost average? Or will you complain in the comment section of a guy called Couch Investor or some other guys on YouTube or on X about, oh, haha, bag holder, oh, shitco, oh, should have sold, oh, should have put in this, should have put in that. Will you do that? Or will you stick to your long-term thesis, the same thesis, nothing has changed other than the stock price? Which one would you pick? Let me know down in the comment section below. And so I've picked out very obvious names: Microsoft, Apple, Chipotle, Netflix, and Amazon. And I've picked out 2000, 2008, 2021, and 2024. Why is that? Well, crucial years. Of course, even between those years, you had highs and you had lows. And for some companies that were not public so early, I've put some other years there as well. So 2015 for Chipotle, 2011 for Netflix, etc., etc. So let's start with number one here, Microsoft. 2000 dot-com bubble. $60 was its peak, dropped 66%. Then 8 years later, if you bought the peak, you would still be down. So 2008, the peak was $38. It dropped 60%. By the way, it recovered quite fast. It recovered before the economy recovers. It's almost always the case. The stock market does recover before the overall economy recovers. Then 2021, it's already now at $345. So even if you bought the peak in 2008 or 2000, you would be up by quite a lot. But anyways, 2021, peak $345, dropped 35%. Now it's at $442, up 642% since the 2000 peak. I can assure you that plenty of people, maybe even including myself, would have sold along the way, would have sold because, oh, again dropping 60%, again dropping 50%, what the heck is this? I'm out. Of course, each and every time here, it's a bit of a different Microsoft, right? Since Satya Nadella came in, of course, you have Microsoft with now cloud, with gaming. Beforehand, they completely missed out on the mobile phone. So yes, I agree, it's a different Microsoft now than it was before. But did the thesis break along all those years? I don't think so. Maybe there were some leaks here and there, but overall, even with those huge drops, which by the way, these aren't even the biggest drops, even with those huge drops, I think a lot of retail would have sold, but a lot of retail would have kept as well. Moving on to the next one, Apple. This is the best one. 2000, $1.30 was the peak. It dropped 83%. I can assure you that most of us would have sold. 2008, of course, much higher than in 2000. It's after the iPhone announcement. The peak, $7.15, drops 60%. Moving to, and by the way, here in between there are pretty big drops as well. Moving to 2021, the peak $180 dropped 30%. Moving to today, 212%, of course, after the recent run-up. It's up 17,471% since the $1.30 peak in the year 2000. Here as well, I can promise you, even after the iPhone announcement, plenty of people would have sold after a 60% drop, 50, 40, 30% drop. Plenty of people would have sold. But if you truly want your 10 or 100 bagger, or in this case 17,471%, you need to hold your shares. Oh, and by the way, this isn't even including dividends. Moving on to Chipotle, a name that has outperformed plenty of high-tech companies. So this one, we start here 2008. The peak, $153. It dropped 70%. Moving to 2015, the peak, $727. By the way, from 2008, 2015, quite a performance. But here again, it dropped 66%. Then 2021, the peak, $1,900, dropped 37%. Today, it's at $3,271, up 2,072% since the 2008 peak. Here as well, it might not be the fancy schmancy sexy name, right? It's a food chain restaurant. Big deal, right? Chipotle. And yet it has outperformed quite a lot of companies. How many times would you have sold your stock between all those periods? Probably plenty. Moving on, Netflix, also a huge performer. The peak in 2008, $6. It then dropped 55%. Moving on to 2011, peak $42. So in 3 years, you performed quite well, even if you bought at the peak of 2008. Anyways, 2011, $42 at the peak, dropped 80%. Moving on to 2021, peak $693, dropped 75%. Remember, everybody said, oh, Netflix just lost 2 million subscribers or so. Netflix is dead. Nobody watches Netflix. There was a guy on the couch who banged on the table and said this is BS. Now we're at $669, up 11,140% since the 2008 peak. Quite a performance. And then last one here, of course, this list goes on and on and on. The last one here is Amazon. $2,005.60 was the peak. It dropped 95%. I repeat, it dropped 95%. Then you basically, if you bought the peak up until 2008, you did nothing because the peak there was 5%. Now imagine you're like, oh, I'm almost break even. That's if you never dollar cost average. I'm almost break even. Then bam, drops 65%. But of course, if you kept on holding, if you kept on studying the company, the business, what is happening with Amazon, then you could have bought more shares. Then fast forward 2021, the peak $188 dropped 55% again. Now we're back at $183. That's up 3,602% since the 2000 peak. Like I said, the list goes on and on. Now, the list can also be extremely long for stocks that you bought at peaks and actually never recovered. Just because it once was at a certain price does not mean that it has to return at that certain price. No, it's important, again, to follow the business. If the stock is completely broken, but the business is not, then eventually it will catch up. Now, for example, a company that I own, of course, I did not own it since 2000, since I was only 6 years old back then, but Intel right now, it's still down 50% or so since the peak in 2000. Yes, the dot-com bubble was insane. Again, I was 6 years old, but if you read about it, it's truly remarkable. So everyone that is trying to compare what is happening right now with the likes of Nvidia's graph is exactly the same. Yeah, if you bought the peak, you would be down a lot and then up and then down, then up and then down, and now you're up quite a lot. But again, comparing what is happening today to what was happening in the dot-com bubble, maybe with some companies it makes sense, but with a lot of the other companies it does not, because back then you had a lot of money, but you did not have the technology. Today, you have and the technology and a lot of money. So it's true that some things, if not a lot of things, are overvalued. But to say that it is the same as back then, I cannot agree, because a lot of companies make a lot of money printing machine, produce products, services. The technology today is much better than ever before, right? The internet is already a thing of 24 years, way more than that, but it matured, it became way faster. You've got cloud. Now you've got AI. I mean, things are moving extremely fast, so I don't think you can compare what has happened before. You can look at similarities and say, oh, okay, this specific company or that specific company, okay, that's truly 100% a bubble. It will blow up in a matter of quarters. Okay, fine. Anyways, going back to the main subject here. As I've shown you, if you want to look at your portfolio and look at multi-baggers in the future, 100 baggers, stuff like that, yes, you will have to go through 50, 60, 70% drawdowns. I'm not saying that every stock that goes down 70, 60% or so is going to be a 10 bagger or so. No, again, it's important to follow the business. I'm not saying that every stock that I own in my portfolio is going to go up by 10x. No, I'm not always looking for 10x, although it could be great if I can find every 10x in the market. But again, laughing about a position or saying, oh, I have to sell this because I'm down, does not make sense. If that's your, let's say, way of thinking when you invest, you should not be investing in individual stocks, buy the index. If you're one that is saying, oh, stock is down 40%, business is doing great or okay, thesis is still intact, let me add a bit more, then you're more likely than not to find a multi-bagger. The other way around just doesn't work at all. That's about it for this video. Of course, I can add more information, etc., etc. Valuation matters, of course, valuation matters. But again, I've seen so many comments on this is one of the benefits of running a YouTube channel on investing, is that I can see so many comments about people that think they sound smart, but it's actually extremely stupid. I'm sorry to say this, but yes, there are some companies, if you're looking at their PE today, you're not looking at the right metric. You cannot expect every single company to have a low PE. No. If it's a super fast up and coming company that is growing extremely fast and has a, let's say, roadmap towards profitability, what's the point at looking for a PE? You will not find an E. You will not find the earnings right now. As the business matures, of course, then the E becomes extremely important. By the way, I think free cash flow is way more important than an PE, but that's just me. Anyways, that's about it for this video. Hopefully it was an enjoyable one, a bit of humor, a bit of seriousness. Hopefully you like that. Do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, and I'll see you all in the next one. Bye bye.